Without further ado, we would like to introduce our main speaker for today, Mr. Damor Sarjanto, Chief Investment Strategist, UOB AM Invest. Damor is responsible for providing leadership in the investment aspect of UOB AM's digital platform. He is also concurrently heads the investment partnerships and solutions unit at UOB AM, managing the firm's strategic tie-ups and investment initiatives with external managers. Damor has over 20 years of investment experience in the finance industry. Over to you, Damor.
Thank you, Priscilla. Good morning, good afternoon, ladies and gentlemen. Thank you for spending your lunchtime with us. Today, I'd like to talk about what is emotional investing and how to avoid emotional investing. But before I start, maybe to get to understand the audience better, let's do a quick poll in terms of your investment experience so that I know how much experience our audience group have. So basically the question asks, which of the following statement best fit your profile? 1, you have never invested before. 2, you have invested through a financial advisor or a robo-advisor. 3, you have invested with a financial advisor as well as on your own. And 4, you make investment decision without any professional advice. Basically, you invested, but basically you invest based on your own knowledge and on your own experience. Let's take a look at how our audience composition looks like in terms of investment experience. Okay, so basically from the look of it, about half of you basically invest, but basically invest on your own, based on your own experience and on your own knowledge. And I think about 8% of you never invested before. Great. You are probably the right audience group that I want to address. And people who've sort of invested on your own. I think all of us basically have a tendency to be guided by emotion in our investment process or in our investment decision. Let's start with a case study that I'd like to show you. If I tell you that this is an index, this is a market index, and this represents a certain market, and the market has actually hit record high month after month for more than 10 times during the last 3 years, and prices have gone up more than 30% during this period. And economic data like GDP and unemployment data and manufacturing numbers are neutral. If I give you this sort of condition, the question is, would you invest in this market? Let's hear from the audience to see how what you think. Would you invest in this sort of market? Yes or no? Okay. Let's take a look at the results. Yes, 61% of you say yes, 40% say no. Okay, good. Then let me give you some further information. If I tell you that this market is in the 10th year of a bull market, that means it has been going up for the last 10 years. And actually, most analysts are saying that return for next year will be in the low single digit. In this given this set of condition, would you still invest in this market? So there are now more information for you. Would you continue to invest in this market? Would you change your mind? Let's take a look at the results. Wow, okay, so now the situation has flipped. 63% of you say no, you will not invest in this market, whereas 53% say yes. Okay, let me reveal what this market is. Actually, what this market really is, the S&P 500. So this is the US market. And had you decided that you will not invest in this market anymore, what you would have done is that you would have missed out the more than 20% return in the last 1 year. And even during this, despite this COVID situation, basically the S&P 500 actually just hit record high again this year, as late as early September. So basically, had you been worried because of what analyst is saying in terms of the expected return being low, you would have missed out the 20% of market return. And so basically, this gives us an idea of what emotional investing is. It's basically investing based on emotion, based on greed and fear, which is the main reason why so many people are buying at market tops and selling at market bottoms. That's actually a fairly common mistake that people make. Warren Buffett has a famous quote that says, "Be fearful when everyone is greedy and be greedy when everyone is fearful." But I think the truth is most of us tends to be greedy and fearful all at the wrong time. We basically tends to be greedy at the top of the market and fearful at the bottom. And this is actually fairly common. This chart basically shows the typical emotional roller coaster that an average investors go through. We start off seeing a market trend, a market going up, and then we say we should watch the trend. And then when it goes up further and we say, okay, we can't wait any longer, you start buying and it goes up more and we think we are smart, we are right. Then the correction happens and then we basically initially we say, okay, we buy that correction. And then the correction continue and we start doubting. And at the end, we ended up getting panicky and selling at the bottom of the market when we can't take the pain anymore. And then again, we are proven right when market goes down slightly more, and then it ultimately market bottom out, and when it starts climbing, we start having doubt, and then when it goes up, almost recovered to where it was, that's when we start looking at it and says, I should be back in the market, and I think that cycle continues. I think this is a fairly typical sort of emotional picture of what an investor goes through. And it is something that many of us have experienced before. And so it's something that we should be mindful of in terms of emotional investing. Then there are other common behavioral biases that we see. Firstly is the herding instinct. I think there is this tendency to follow the crowd. I think we are more comfortable when we think that we are, when the crowd is with us. Standing apart from the crowd is always uncomfortable because we sometimes doubt how could we be right when everyone else is saying one thing and we saying the other. So we tend to follow the crowd and we have a tendency to buy when everyone is buying, which basically typically marks the market top. And then when everyone is selling, we generally tend to follow that as well, and we panic sell as well. And that's basically what we call the herding instinct. And that's why we tend to buy the tops and sell the bottoms. The second bias that we tend to have is what we call anchoring bias. I think as an illustration, for example, we tend to look at, maybe we start looking at DBS at $20. And once we have that $20 as a price anchor in our mind, we tend to remember that $20. And then when it drops to 18, that's when we basically think that it is cheap and we basically rush in. And then if it goes up to 22, 23, we start thinking that it's expensive and we start selling. So because we have a certain anchor in mind, we have a certain price anchor in mind. I think it's the same for the other side. For some things, sometimes for certain stocks, we see an anchor of $5 and then we basically, when it reaches $6, we think that it's expensive and we sell out without really thinking very hard about it. And because of that, we end up missing sort of what could have been a two-baggers or a three-bagger, right? So that's anchoring bias. The third bias that we have a tendency to see is basically what we call fear of missing out. right? This tends to happen near the top of a market. We see people around us making money. Everyone is investing and making money, and we fear of missing out because we are not making that money, right? And sometimes for some people, they actually look at the missing out as a loss, and I think that's dangerous because that basically causes the mind to tend to jump in the next time they see something, or they think that there's an opportunity. But actually what is happening is that there is the decision is really guided by a fear of missing out rather than really objective evaluation. And the last but not least, we talk about market timing. There's a lot of time that people think that they can time the market. And so even if prices have dropped to a level that looks attractive, you still want to wait it out because you think that there could be another 5% downside, and you try to capture that 5% further discount. Or when market is already looking toppish, but you still want to capture that last few percent of upside. And so you try to time that market thinking that you could do it, but actually market timing is really, really difficult. And in fact, even for most professionals, it's almost impossible to get it right most of the time. So these are some of the common behavioral biases that actually affect and influence investors' decision. And what's really the interesting thing is how it really affects the average investor. This is a study that's done in the US, but it's probably true across the world. This actually shows what the market return has been over the 1 year, 3 year, 5 year, up to 30-year period, and what average investors really make in terms of return. So if you look at it, basically, regardless of what sort of investment horizon you're looking at, the average retail investors generally don't benefit fully from sort of market return. And I think that's partially because of this, of all these emotional investing and all these behavioral biases, whether you are trying to time the market, whether you are trying to, whether you end up with herd instinct, or whether you basically are guided by greed and fear. The results is that most retail investors actually don't participate fully in market return, and you end up with almost about 5% underperformance annually to what market has actually really delivered. So if you look at the sort of long-term return, while sort of market has returned about 10%, most investors have actually benefited less than 5% in terms of return. So basically, that's the experience that the average investors tends to go through. So what are the strategies to avoid emotional investing? I think there are a few strategies that we recommend to investors in terms of how you can avoid emotional investing. Firstly is that you need to be aware of these biases, especially the biases that you have a tendency to succumb to, whether it is herding, whether it's anchoring. I think starting with a position of awareness helps you to be mindful of it and to avoid it. So basically, this helps you to keep your emotion in check. A lot of time, we basically suggest that when you come in, look at it with a fresh pair of eyes, look at it objectively, so that you don't get a baggage of whether be a price anchor that has sort of influenced you, or whether the market sentiments that's influenced you. Look at the situation with a fresh pair of eyes. And also the second thing that we also recommend is avoid putting yourself in a situation where you can be easily influenced by hearsay and sentiment. I think you've seen this cartoon before. Basically, a rumor in the market could actually trigger a panic selling, and then basically just a casual comment again could sort of trigger a rally and a buying frenzy. So basically, one should try to avoid putting yourself in this sort of environment. In fact, for most of the time, we suggest that you stop reading daily market commentaries, simply because all these daily market commentaries many times is about the market commentator trying to justify why market is usually up 0.5% or down 0.5%, when it's really normal market volatility. It becomes noise it really is market noise, but for market commentators, because they need to justify a reason why market is up or down, sometimes they basically have to find any excuse to explain it. So basically, to us, we suggest that you put away, you don't put yourself in this situation that you will be influenced. Come into the market with a fresh pair of eyes, and basically that helps you to avoid this sort of emotional investing. Another common strategy that we tend to suggest is really to look at dollar cost averaging. If you look at this, basically what it really is instead of, say, investing everything at one go, is that if you have an investment amount, divide that investments into periodic investments. So maybe for example, if you have a lump sum of 8,000 at the start, what happens is that if you put everything at one go, say at $10 in January, by the time you reach August and the share price is still $10, what you have done is you've actually returned that lump sum. That lump sum return is really 0%. So what we suggest is that instead of doing that, what you do is that you do a monthly installment of 1,000 and spread it out monthly, and don't think too much about the price, and basically just take the average cost. The benefit of this approach is that you get an average. You won't be buying things at its cheapest, but you also won't be buying at the most expensive. You tend to get an average price, which basically helps you avoid the risk of investing at the highest point. So in this instance, if we look at it in this example, at the end of the period with $10, the average cost is really $9.60. You actually generated about 4% return by using dollar cost averaging rather than having 0% return if you basically just buy everything right from the start. So that's what we call dollar cost averaging. But obviously, there is a right way and a wrong way of dollar cost averaging. We suggest dollar cost averaging for markets because generally markets have a natural tendency to be upward moving. Then markets have a natural tendency to grow, and therefore dollar cost averaging is probably a right strategy. If a company's fundamental remains intact and the company is still growing, then dollar cost averaging makes sense. The wrong way of doing dollar cost averaging is that when a company's fundamental has deteriorated and share price fell as a result, and basically you think that you are doing dollar cost averaging, but simply what you've done is instead of cutting losses, you basically keep on reinvesting or doubling down your position in a deteriorating company. I think that's probably the wrong way of doing dollar cost averaging. So I think there still need to be some thought behind dollar cost averaging. We recommend it for markets in general, and we recommend it for companies that fundamental is good, but for companies in which the fundamental has changed, dollar cost averaging may be a wrong strategy to use. And then we basically suggest that you prepare and plan for your investments. I think being prepared and planning for it would definitely help you to avoid the pitfalls of emotional investing and all the behavioral biases. Firstly, we suggest that you establish a financial objective and goals and your investment time horizon. For example, what is your financial objective? Are you trying to invest and build your egg nest for your retirement? Are you trying to invest to save for your down payment for your house? I think having that financial objective and investment goals and investment time horizon helps. that allows you to time your to spread out your investment time. That helps you to plan your investments and also allows you to understand how much risk you can take in terms of your investment portfolio. The second thing that we suggest is to maintain a long-term view. Basically, we don't advocate a short-term trading position. We are not traders. If your investment objective is to make 10% next week, I'm sorry, unfortunately, we can't really help you there. We are not traders. That's not investing, that's really trading. But if your investment is really to try to grow your egg nest, and you say, I want to grow it by about 8% every year for the next 10 years, or I want to grow it by about 5% in the next 10 years. And I think for those sort of investment horizon, those sort of realistic financial plans, I think we can help you there, or you can have a more realistic investment plan. Thirdly, we recommend diversifying across asset classes. Putting your money in stock market is good. Basically, stock market have a natural tendency to grow, and therefore the returns in the long term, it tends to be positive. But usually for many people, there's always the other aspect, meaning that the volatility aspect that you may feel that you might feel anxious if when market goes down. So diversifying across asset classes actually helps to buffer that, meaning that if you put some fixed income or some bonds in your portfolio besides equities, that actually lowers the volatility of your portfolio. And it also diversifies in the sense that when equity market goes down, bond market generally does relatively well because there is a flight to safety. And so the bond market tends to deliver a sort of positive return that offsets your losses in the stock market. So generally, diversifying across asset classes helps your portfolio. Fourthly, we suggest that you invest an amount that you are comfortable with, meaning that if you don't put in money in investments that you can't afford to lose. Meaning that if you cannot stomach mark-to-market losses, or you cannot stomach market volatility in your portfolio, because then basically that is not the amount that's not the money that you should be investing. Any money that you put in your investments should be something that you are comfortable if there is some market volatility and there's some market drawdowns, and you say that's fine. I can't afford to lose that kind of money. And therefore you're okay. So generally we suggest that don't try not to gear up to invest, don't borrow money to invest only money that you're comfortable with and money that you can afford to see some volatility and some mark-to-market losses with. And finally, we said be disciplined and stick to your plan. Usually having a regular investment plan is a good way that basically force you to be disciplined in setting aside money and invest. That basically is a natural way of dollar averaging. And once you have that plan, try to stick to it and don't deviate. Don't try to time the market and says, oh, I think market is toppish and therefore I should withdraw from the market, because that is, again, you fell into the sort of the trap of trying to time that market. So we basically don't recommend that. Stick to your investment plan. Just keep on putting money and keep on staying invested. And I think that probably helps in terms of avoiding all these pitfalls. Okay, with that, we generally come to the end of my presentation. So I hope this has been helpful. This has been helpful in understanding what is emotional investing and some of the other behavioral biases that could detract your investment performance. And so now I'll pass you back to Priscilla, who would take you to the next segment of this presentation.
Right, thank you, Damo, for the insightful and informative explanation. For those who missed out on the housekeeping rules, you can post your questions in the Q&A by selecting the Q&A icon shown on the control panel. You can even vote questions raised by the other attendees. Firstly, I would like to address that any questions that in regards to comparison with competitors, we will address them in the following up emails. Thank you. So firstly, let's start with the first question, which I think myself, I would like to ask this question. Talking about comfortable amount to start investing, what would be recommended amount to start off, and especially for new investors, and how much do you recommend to put in as capital to see a good growth?
Thanks, Chris. Basically, there is no right answer to that question. I think in the past, it used to be, we always suggest that, or people who want to invest usually says, I need to put in a big lump sum amount or a certain lump sum amount to start before I can invest. I think what we have seen is that in recent years, the development in financial markets have reached a stage that even if you start with a small amount, there are avenues for you to invest in. For example, in robo-advisors, most robo-advisors actually allow investments up with very small amount. For example, our own robo-advisor, the UOB Invest, allows investment for as small as $1, right? So there's really no amount too small that you invest with. But what we actually suggest and actually recommend and advocate is really this. Start by doing something. Start with an action. Take that action to start investing. Because the biggest fear is really inertia in which that if you don't start, then nothing gets done. If you start with $1 and then basically you are comfortable with it, and then whenever you have extra money, you sort of put it in that sort of, you start putting in your portfolio, and at least that helps start your investment journey. What is the right amount is really up to you, right? So basically, usually we tend to suggest that people should set aside about 10% of your income in your IGNES, whether as savings or as an investments. So basically, that would be a good number to start with. If you have a lump sum of savings that's sitting in a deposit account, today it's actually almost earning nothing. Maybe an investment portfolio should be a right one for you. So basically, there's no right amount, but the real idea is to get started. And I think that helps to start your investment journey.
Right. Thank you, Dharmo. So yes, I think there's one question. How different are we UOB AM Invest compared to competitors out there?
Okay, so basically with UOB AM Invest, there are a few things that we are different from our competitors. One is, of course, our experience as fund managers. We have been 30 years in this business, so we put in our investment experience in the design of the robo-advisor, including things like our proprietary capital market assumption. That means that we actually, for each asset class that we use in the robo-advisor, we actually have our own research that basically does the capital market assumption, or comes up with the capital market assumption. And this is important because if you have the wrong capital market assumption, if you study finance textbook and you ask what is the expected return for equity market, most textbook will tell you is about 8%. 8% is a sort of a long-term expected return for equity in most textbook, and a lot of other robo-advisors simply use that generic, what we call a generic capital market assumption. Whereas in UOB AM Invest, what we do is that we not only look at sort of that sort of long-term return, but we look at what is the current valuation for equity markets today. So if the equity market is expensive today, then the expected return for the next 10 years for equity market should actually be lower. So if you start from overvaluation, instead of 8%, the capital market assumptions that we put in is probably more like 6%, right? Whereas on the other hand, if equity market looks cheap, then the expected long-term return of equity market would be higher than that 8%. And having a wrong capital market assumption could actually be detrimental, because if equity market is expensive today, and you still put an 8% equity market expected return, then the robo-advisor or the algorithm might actually over-allocate your portfolio to equity simply because of the attractive return. Whereas a sort of 6%, a more realistic capital market assumption would actually adjust your portfolio to give you a more balanced portfolio. I think so. Those are some of the areas that are different, that we are different from the competitor. The other thing that's different is that we use a glide path approach, meaning that when you have a 10-year investment horizon, for example, we may start allocating a portfolio that is, say, for example, 50-50 between equities and fixed income. But as you draw nearer and nearer to your investment goals, say, for example, if you have, say, 2 years left in your investment horizon, your portfolio should not stay at 50-50, because now your investment horizon is only 2 years left. We should actually be protecting your portfolio more. So it should actually allocate more to fixed income and less to equities. So that portfolio should actually gradually glide from a 50-50 towards something that is more inclined towards fixed income than equity. So that's what we call a glide path, and we actually employ that in our solution, which is not what everyone does. Over to you, Pris.
Thank you, Damo. So I have another question. Instead of the dollar cost averaging strategy, what do you think of the strategy of investing more whenever the markets are down by at least 5 to 10% from the recent highs?
I think that's an interesting strategy. There's a contrarian strategy, and it's actually could be good if you can be disciplined and do that. I think that's basically beneficial. The question is whether how long you can maintain that sort of strategy if market keeps on going down. But basically, I think that's generally an appropriate strategy. The other way the other sort of similar way that we tend to sort of avoid this sort of the other similar way that we do dollar cost averaging is that in our robo-advisor, we do rebalancing. We do a sort of regular rebalancing, meaning that as market, say for example, as equity market goes up, what we do is that, and therefore your portfolio moves away from the initial allocation. Say for example, if you start with 50-50 and then your equity, and when equity market goes up 10%, the equity portion exceeds 50%. It's more like 55% when your bond portfolio is now 45%. What the system and the algorithm does is that it will actually sell part of your equity portfolio and reinvest it in a bond portfolio. So those are basically a way of rebalancing the portfolio to bring it back to 50-50. And it's a very disciplined and systematic way of selling and taking profit and reinvesting your portfolio in to recreate that balance. So I think investing when market is down, or putting more money when market is down, I think that's generally a good approach. That's a contrarian approach, although it could be something that most people are uncomfortable with. Sort of a regular dollar averaging might be something that more palatable to most people.
Thank you, Damo. I have a final question for you. Do you think a small portion of gold is good in the investment portfolio? And is UOB AM Invest looking to have some gold in the holdings?
I think having a bit of gold in the portfolio is good. It's a very good diversification from all the other asset classes, and it serves two purposes. One is a safe haven assets. So when things are choppy, when market are choppy, gold tends to do well as a safe haven asset. Secondly, it is a good inflation hedge. At this moment, obviously, inflation is not a problem. But given that there's so much money printing in the world today, I think there are concerns that inflation will ultimately come back. And gold actually is a very good inflation hedge. So these are some of the reasons that investors hold gold. And I think it's always helpful to have a bit of gold in one's portfolio. So UOB Invest is looking at having gold as part of our solution. At this moment, it is still work in progress, but it's definitely something that we're thinking about.